In less than 24 hours, the Federal Reserve is going to make a decision, and it's a big one. This isn't just about the US economy, it's almost certainly going to dictate where the crypto markets go for the rest of this year and deep into next. This is not just another meeting, it's a potential turning point, a moment where the financial ground could literally shift beneath our feet. And you can bet the mainstream media will be fixated on the headline interest rate number, but they're going to miss the real story. They're going to miss the signals buried in the Fed's official statement and Jerome Powell's press conference. Those are the signals that really matter. They tell us where the liquidity is actually going. I'm going live tomorrow to cover this whole thing second by second as it all unfolds. But before I do, you absolutely have to understand what I'm looking for. I'm not just watching for a rate cut. Everybody expects that. The market's already priced it in. I'm tracking two under the radar signals and one massive systemic risk that almost nobody is talking about. The first is a subtle change in the pace of quantitative tightening, or QT. The second is a metric I call the job curve steepness, which I believe is the real trigger for the next huge move in Bitcoin. And the third is the ticking time bomb in the private credit markets, a hidden danger that could force the Fed's hand in a way no one sees coming. In this video, I'm giving you the full pre-flight briefing. I'll show you exactly what these signals are, why they matter more than the headline number, and how they connect directly to the price of Bitcoin and your portfolio. This is your essential guide. This is what you need to know before I go live tomorrow to trade this event. So pay close attention because the moves that happen tomorrow will be fast. And if you're not prepared, you're going to get left behind. To really get the magnitude of what's about to happen, you need to understand the corner the Fed has backed itself into. To put it mildly, they are caught between a rock and a hard place. On one side, you have a labor market that is showing real signs of weakness. For months, we've seen job growth slowing down. Some data even suggests most new jobs are packed into just a few sectors like government and healthcare, while the rest of the economy is basically flatlining. Jerome Powell himself has admitted that the downside risks to employment are rising. This weakness is the main argument for cutting interest rates. The idea is to make it cheaper for businesses to borrow and hire, and hopefully stave off a painful recession. But on the other side of the coin, there's inflation. While the headline numbers have definitely cooled off, inflation is still stubbornly sitting above the Fed's 2% target. Fed officials keep saying that the risks around inflation are still tilted to the upside. This creates a huge conflict. If they cut rates too much to save the job market, they risk reigniting the very inflation fire they fought so hard to put out. But if they keep policy too tight for too long to kill inflation for good, they risk breaking the labor market and sending the economy into a deep recession. This is the tightrope Powell has to walk. Every single word he says will be dissected for clues about which of these two jobs, maximum employment or stable prices, he's prioritizing. Right now, the market is expecting a very dovish pivot. Prediction markets are showing an over 80% probability of a 25 basis point rate cut at this meeting. The CME FedWatch tool shows even more certainty, with traders pricing in a nearly 99% chance of that quarter point cut. In fact, the market is so sure it's already pricing in another cut in December. But here's the critical point that so many people are missing. A 25 basis point cut is already baked in. It's consensus. It's not a surprise. A simple quarter point cut by itself is not going to be the catalyst for a huge market move. It's what happens around that decision that will create the real fireworks. It's the forward guidance, the small changes in language, and the technical tweaks to their other tools that will give us the real signal. To make things even harder, the Fed is navigating through a data blackout caused by a recent government shutdown, which delayed key reports. They are flying partially blind, using a mix of public and private data to make a decision that impacts trillions of dollars. This uncertainty just raises the stakes even higher. They are trying to land a 747 on a postage stamp in the middle of a hurricane. The turbulence is real, and the margin for error is razor thin. And that's exactly why we can't just watch the headline. We have to look deeper. The first, and arguably one of the most important signals I'll be watching for, has nothing to do with interest rates. It's about the Fed's balance sheet and a process called quantitative tightening, or QT. If you've been following my channel, you know I never shut up about this, and for good reason. It is one of the most powerful and misunderstood forces in finance today. So what is QT in simple terms? Think of the economy as a giant bathtub. During the 2020 crisis, the Fed turned the taps on full blast. That was quantitative easing, or QE. They printed trillions of dollars and bought up assets like treasury bonds. This flooded the system with liquidity, the water in our tub, making it cheap for everyone to borrow money. That massive liquidity injection was a huge reason for the last bull market in stocks, and of course, Bitcoin. Quantitative tightening is the exact opposite. It's the Fed pulling the plug on that bathtub. They aren't actively selling bonds, they're just letting them roll off the balance sheet as they mature. When a bond the Fed owns matures, the Treasury pays the Fed back, and the Fed basically deletes that money. Poof, gone from the system. This process has been quietly draining liquidity from the markets, acting as a headwind against risk assets like crypto. The Fed's balance sheet has already shrunk quite a bit from its nearly $9 trillion peak. Now, here's why tomorrow is so critical. There's a growing number of analysts and even some Fed officials who think it's time to slow down or taper this process. Major banks like JP Morgan and Bank of America have moved up their forecasts, suggesting the Fed could announce an end to the runoff as soon as this month. Why the sudden rush? Because QT might be working too well. It's draining liquidity so fast that cracks are starting to show in the financial plumbing. We're seeing stress in critical funding markets where banks lend to each other overnight. The Fed is terrified of another September 2019 repo crisis, where those rates spun out of control, forcing them to intervene. Chairman Powell himself gave us a hint in a recent speech. He said, "We may approach that point in the coming months." This was a direct signal that the end of QT is on the table, and the coming months could very well mean tomorrow. The announcement could come as a taper, slowing the pace of the runoff, or a full stop. What am I looking for specifically? I'll be scanning the official FOMC statement for any sentence or phrase about the balance sheet, runoff, or normalization. The statement is usually incredibly boring and repetitive, so any change is a massive signal. Then, during the press conference, a reporter is guaranteed to ask Powell about the plan. His answer will be everything. Will he be vague, or will he give a concrete timeline, announcing that they've decided to start tapering in November or December? This is the single most bullish thing that could come out of this meeting. Announcing a QT taper or stop would be a huge dovish signal. It would mean the Fed isn't just cutting rates, they're also stopping the drain in the global liquidity bathtub. It signals that money is about to get easier, not tighter. For an asset like Bitcoin, which is so sensitive to global liquidity, this would be like rocket fuel. The last major crypto bull run came right after the Fed massively expanded its balance sheet. The end of QT could signal the start of the next great liquidity cycle. On the flip side, if Powell and the statement say nothing about QT, if they just ignore it, that would be a very hawkish signal. It would mean they're still more worried about inflation than financial stability and are willing to keep draining liquidity. That scenario would be a major headwind for Bitcoin and could trigger a sharp move down. So forget the rate cut for a second. The real story tomorrow is what they say or don't say about quantitative tightening. That's signal number one. Now, for the second signal, this one is a bit more advanced, but it's absolutely crucial. I call it the job curve steepness. You won't hear about this on cable news, but I believe it's something the Fed is watching very closely. So, what is this job curve? It's not a chart you can just pull up on a screen. It's more of a concept for understanding the health of the labor market. It's the relationship between things like job openings from the JOLTS report, how many people are getting hired and how many are leaving their jobs, quits and layoffs. Think of it like this. In a healthy, booming economy, you have a very steep curve. There are tons of job openings, hiring is strong, and this is important, the quits rate is very high. A high quits rate is a sign of confidence. People are quitting because they know they can find a better, higher paying job quickly. That was the story of 2021 and the Great Resignation. For the Fed, a steep job curve screams inflation risk because strong wage growth means more spending power. Now think about the opposite. A flattening curve. This is what we've been seeing lately. Job openings are coming down, hiring is slowing, and crucially, the quits rate is falling. People are getting less confident and are holding on to the jobs they have. This tells the Fed their rate hikes are working. It suggests wage pressure is easing, so inflation should come down. It gives them the green light to think about cutting rates. The danger is if the curve flattens too much or too fast. That can be a warning sign of a sharp rise in unemployment. The Fed wants to avoid this at all costs. They want a soft landing where the job curve flattens just enough to cool inflation without crashing the whole job market. So, when Powell steps up to the podium, I'll be listening to how he describes the labor market. He won't use my term job curve steepness, but he will talk about its parts. He'll mention the balance between labor supply and demand, job openings, and wage growth. His interpretation of these mixed signals is everything. If he emphasizes that the labor market is just coming into better balance and that wage growth is still a bit too high, that's hawkish. It means he thinks the curve is still too steep. That would imply this is a one and done rate cut with a high bar for any more cuts. But if he focuses more on the slowing job gains and admits the risks to employment have gone up, that's a huge dovish signal. It would mean he sees the job curve flattening fast and is now more worried about a recession than inflation. That would open the door for a whole series of cuts, just like the market is hoping for. Why is this tied to Bitcoin? Because the labor market is the main thing driving the Fed's decisions right now. A dovish read on the job curve means more rate cuts are coming. More rate cuts mean easier financial conditions. That is undeniably bullish for risk assets like Bitcoin. It's the market's signal that the Fed is pivoting from fighting inflation to stimulating growth. That's the macro environment where Bitcoin thrives. The third signal is a two-part wildcard. The first is the classic art of Fed speak, deciphering the tone and specific words Powell uses. The second is a huge risk building in the shadows of the financial system, the private credit market. This is the wild card that could force the Fed into a much bigger easing cycle than anyone is imagining. Let's start with Powell's language. In every press conference, there's a battle between the hawks, who worry about inflation, and the doves, who worry about jobs. We know the committee is divided. Powell's job is to represent the consensus, but his own words can shift the market's perception of where that consensus is leaning. I'll be listening for key phrases. Does he describe inflation as transitory or as persistent and sticky? Does he call the economy resilient, or does he use more cautious words like moderating and softening? Does he frame this cut as part of an easing cycle or a mid-cycle adjustment, a phrase he's used before to signal only a limited number of cuts? The difference between single words can move billions of dollars, but the language is only half of this wild card. The other half is the private credit market. This is the black swan hiding in plain sight. Over the last decade, as banks face tighter regulations, a new shadow banking system has exploded. Private credit funds, non-bank entities, lend directly to businesses. This market has swelled to over $1 trillion. Here's the problem. This market is opaque and unregulated. And here's the kicker. These private credit funds rely heavily on credit lines from the big banks for their own liquidity. What happens in a downturn if the loans these funds made start to go bad? They would all rush to draw on their credit lines from the banks at the exact same time. This could create a sudden massive liquidity drain on the entire banking system, a domino effect that could freeze credit everywhere. The Fed is aware of this. Their own research has flagged this as a potential systemic risk. While they've indicated it isn't an imminent threat, they also noted that major losses would only happen in severely adverse economic conditions. The question is, how close are we to those conditions? This is the wild card that could shatter everyone's neat and tidy expectation of a simple rate cut. If Powell is asked about financial stability and mentions growing concerns about private credit or non-bank lenders, the market will listen very, very carefully. And here's the twist. While the first reaction might be fear, the second reaction could be wildly bullish for Bitcoin. Why? Because if the Fed thinks a real systemic risk is brewing, they won't just cut rates by a quarter point. They'll be forced to act aggressively. They would have to open the liquidity floodgates, slashing rates, stopping QT instantly, and maybe even launching new emergency lending programs. The response to a systemic threat isn't a gentle tap on the brakes. It's flooring the gas pedal. So when I listen to Powell, I'm listening for any mention of financial stability, non-bank lenders, or private credit. If he acknowledges these risks are growing, it tells me the potential for a much larger, more aggressive easing cycle is on the table. This is the black swan that could trigger a liquidity injection that makes the post-2020 stimulus look small. And in a world flooded with new money to patch up systemic cracks, hard assets like Bitcoin become the ultimate safe haven. That's signal number 3. Okay, we've gone through the briefing. We have our 3 signals, the QT taper, the job curve steepness, and the private credit wildcard. Let's put it all together and map out the flight paths for Bitcoin. I see 3 main scenarios. Scenario 1, the bullish dovish pivot. This is the dream scenario for crypto bulls. The Fed delivers on all fronts. They cut rates by 25 basis points. Crucially, Powell announces a plan to begin tapering or ending QT. He uses dovish language, emphasizing the risks to the job market and suggesting inflation is heading back to 2%. His comments signal the Fed's priority has officially shifted to promoting growth. Impact on Bitcoin. The market reaction would be immediate and explosive. An end to QT combined with a clear signal of more rate cuts would remove the main macro headwinds. We could see a rapid breakout as sideline capital rushes back in, believing the Fed has given the ultimate risk-on green light. This is the scenario that could kickstart the next major leg up in the bull market. Scenario 2, the bearish hawkish disappointment. This is the nightmare scenario. The Fed cuts rates, but it's a hawkish cut. There's no mention of a QT taper. Powell's tone is firm. He stresses the fight against inflation isn't over and hints that the market is getting ahead of itself, pricing in more cuts. He'd essentially be telling the market, you get this one cut, but don't expect more unless things get much worse. Impact on Bitcoin. This would be very bad for Bitcoin in the short term. The market has fully priced in a dovish pivot. Pulling the rug out would trigger a big risk-off move. Bitcoin would likely see a sharp correction as the liquidity drain from QT continues. This is the scenario where the recent rally could come to a painful end. Scenario 3, the volatile, confused signal. This is probably the most likely and the trickiest scenario. The Fed gives us mixed signals. They cut rates, but the messaging is muddled. For example, Powell might hint at a future QT taper, but give no timeline. He might talk tough on inflation, but also acknowledge the weak job market, leaving everyone guessing. Impact on Bitcoin. The initial reaction would be pure chaos. We'd see the price whip back and forth as algorithms try to figure out what he means. After the dust settles, the market would likely be stuck in a choppy sideways range. This scenario resolves nothing and just kicks the can down the road to the next meeting. My job tomorrow on the live stream is to analyze these signals in real time and figure out which of these three paths we're heading down. Everything I just laid out, the QT taper, the job curve, the private credit risk, these are the instruments on my dashboard. Tomorrow, as Jerome Powell speaks, I'll be watching them in real time, interpreting every word and every market reaction, second by second. I'm going to break it all down live as it happens. We're going to navigate this volatility together. If you want to see my real-time analysis and understand what it all means for Bitcoin the moment the news breaks, you need to join me for the live stream tomorrow. You don't want to get this information on a delay. The moves will be too fast. This is your chance to be in the cockpit with me as we navigate one of the most important financial events of the year. Click the notification bell, set a reminder, the link is in the description. Be there. Tomorrow is not about the 25 basis point rate cut everyone already knows is coming. It's about the signals hidden just beneath the surface. First, we're watching for any news on slowing down or ending quantitative tightening. This is the biggest liquidity signal the Fed can possibly send. Second, we're listening to how Jerome Powell describes the labor market. His take on the job curve steepness will tell us if the Fed is really pivoting to supporting growth, which means more rate cuts are on the way. And third, we're on high alert for the wild card, any mention of systemic risk in the private credit markets. This is the black swan that could force the Fed to open the liquidity floodgates. These three things will determine where we go from here. The stakes couldn't be higher, the ground is shifting, and tomorrow will set the trend for months to come. Make sure you're prepared. I'll see you on the live stream.